Have the numbers been good enough to justify the kind of incredible 2019 that we've had so far?
No, in short. Earnings trajectory has certainly been much softer than what we've seen in the stock market. My concern, though, is less about the top line. The next recession may be more than a year away. So slowing sales growth doesn't worry me as much as rising costs right now. And this is what I'm listening to on the conference calls that I'm tuning into. It's not so much overall industry conditions or talk about trade, those macro issues. It's the micro of rising costs, not just on the energy front, which we all know about with the renewed Iranian sanctions, but it's the labor costs, which makes up 70% of the cost of goods sold for most businesses. Those are the highest they've been in many, many years, and they're really impacting profit margins. There's a lot of leverage there, keeping those earnings numbers very soft. And I'm worried that over the remainder of this year, we're not going to see a sharp rebound. We might see either more of the same, low single digits, or maybe something even worse.
But if the market expectation's been ratcheted down, that this is already baked in, or this is acceptable?
It depends where you look. I think in Europe, those expectations have been ratcheted down. Remember, the EFI index of non-U.S. developed market stocks is still 13% off its all-time highs. That's reflecting more pessimistic conditions. But I'm not seeing that in the U.S. market. I'm not seeing that in some sectors like technology, where I think there's still a very robust outlook for renewed earnings growth.
Let's talk about the second aspect, and that is corporate buybacks. Companies have been buying back a lot of stock in the last couple of months. How much has that reduction in available equity contributed to this kind of a run?
I think that's been a big part of it. We haven't seen a lot of purchasing by individual investors. They've turned back, really neutral on equities. Maybe in recent weeks, they've picked up a little bit of buying, chasing some of the gains. But obviously, for the most part, the big buyer have been corporate share buybacks. We haven't seen big participation by foreign institutions or endowments or insurance companies. It's really been about corporate share buybacks. And that does worry me, particularly as we head into what we often call the buyback window closing here during the peak of the reporting season. So we might be set up for a few weeks of weakness if that buyback begins to fade a little bit.
Well, and let's take it one step further, Jeff. And I would say that according to at least some of the money flow data that we have seen in ETFs and everything, not only is the retail investor not aggressively buying into the market, but is he or she actually a net seller in some cases?
In some cases, yes, although interestingly, they've continued to purchase bonds. You mentioned earlier there's money for stocks, there's money for bonds. That usually doesn't last. Usually it goes one way or the other. We usually see bond yields rising with stocks, and we haven't seen that this year. There still remains robust interest in the bonds. We're seeing that across the industry flows. We're also seeing it here at Schwab, and that tells me maybe there might be limited additional appetite for equities.
Okay, so let's use the football analogy. I guess we'll have to use the Patriots because you're up there in Boston. The most overused phrase in financial news is money on the sidelines. We hear that. And we think about that. I think about one player coming off the field. Maybe that's money coming out of something, and another player coming in, right? There's one-for-one swap. What has been so amazing this year, really in the last couple of months, is that it's like there's a ton of players all going in, and nobody appears to be coming off. The money's flowing into oil, into Europe, into China, which we'll get to in a second, into bonds, into U.S. equities. Where is all this money coming from?
Yeah, it's a good question, and that's what it certainly highlights the point you made earlier about a lot of the money going into equities coming from corporations, which do have a lot of cash. Individual investors, their cash balances are not above average right now. They're pretty fully allocated to equities relative to historic highs. So there's not potentially a whole lot of more fuel there from an individual investor standpoint. And as we take a look at other, again, foreign institutions, endowments, pension funds, they're not flush with cash right now either. So a lot of that cash, at least on the equity side, has been coming from corporations. They've got that cash. The question is, will they continue to be willing to spend it on equities in an environment where maybe things get a little tougher in terms of further cash flow growth?
Quickly, in your mind, I saw your tweet the other day, Jeff. Do you believe that China is contributing to a global bubble?
I do. I worry about this a little bit. So we've seen 40% growth in new loans and new social financing in China, yet only 6% business spending growth this year. I think the rest of that money is finding its way into the Chinese stock market. That is a big risk of a bubble there in China, which makes up a third of the emerging markets index. So that index could be vulnerable here as we look to the remainder of the year.